When can a state require you to collect sales tax? Well, the trigger for this is called Nexus. And in this video, we're going to simplify Nexus to help you understand what it is, the two main ways you create it, and the common traps that can surprise businesses. The goal is to help you understand how to tell if a state can legally make you collect and file. Now, the most traditional form of Nexus is called Physical Nexus. It is the original form of Nexus and the easiest to understand. Physical Nexus means your business has some kind of physical presence inside a state. That could be something obvious, like an office where your employees work, a warehouse or a storage facility that holds your inventory, a retail store showroom where sales occur in person, or even employees or contractors or sales reps who live and work in that state. But it also includes some things that may surprise you. If you send team members to a trade show in another state, perform on-site installations, or have inventory stored in a third-party warehouse, like some businesses do with Amazon's Fulfilled by Amazon or FBA network, you could create Physical Nexus there. Once that physical connection exists, the state can legally require you to collect and remit or send in sales tax you've collected on sales made to customers in that state. Physical presence rules haven't gone away, they've just been joined by another newer rule set, which is Economic Nexus. In 2018, the US Supreme Court decided a landmark case called Dakota versus Wayfair Incorporated. That ruling changed everything for e-commerce and out-of-state sellers. Before Wayfair, you needed physical presence to create Nexus. After Wayfair, states were allowed to enforce Economic Nexus, meaning a business could trigger sales tax obligations purely by the amount of economic activity they had in that state, even without a physical office, employees, or warehouse in that state. Now, in most states, that threshold is $100,000 in sales or 200 separate transactions in a single year. But some states like California, Texas, and New York set their own thresholds. For example, California's threshold is $500,000 in sales with no transaction count. With all of that said, let's walk through a couple of quick examples that apply at the time of the recording of this video. The first example is when Economic Nexus is triggered. Let's say you run an online apparel shop based in Florida, and over the past year, you've made $125,000 in sales to customers in Georgia. Even though you don't have a store or any staff in Georgia, you've crossed Georgia's $100,000 sales threshold. That means you now have Economic Nexus in Georgia, and Georgia expects you to register in their state and collect sales tax from Georgia customers and remit it to the Georgia Department of Revenue. The second example is when Economic Nexus isn't triggered. Same scenario, but instead of $125,000, you only made $85,000 in sales to Georgia, spread across 150 transactions. That's under both the dollar and transaction thresholds. So you haven't created Nexus yet. You can continue selling into Georgia without collecting their sales tax at least until you cross over a threshold. Now, if you want to check each state's exact threshold, we've linked our Economic Nexus by state chart in the video description for ease of reference. It's a helpful reference showing which states use sales dollars, which use transaction counts, and which have unique rules or effective dates. But what if you have both physical and Economic Nexus? This comes up all of the time, and the answer is actually really straightforward. If you have both, the rule of thumb is this: whichever Nexus came first governs the start of your obligation. Every state has an effective date, which is the point in time when its Economic Nexus law officially took effect. And for many states, this was sometime in mid to late 2018, after the Wayfair decision. So let's look at two scenarios. Scenario one is where Physical Nexus is first. Imagine you hired an employee in Ohio back in 2018, but you didn't cross Ohio's economic threshold until 2020. Since your physical connection existed first, you were responsible for collecting and remitting sales tax in Ohio starting back in 2018, not 2020. Scenario two is where Economic Nexus is first. Take our first scenario and flip it around. Let's say your online sales in Ohio crossed the $100,000 threshold in 2018, but you didn't hire your first employee based in Ohio until 2020. In that case, your obligation began in 2018, the moment you met the Economic Nexus threshold, even though the physical presence came later. Either way, the key point is that Nexus doesn't stack or reset. It simply establishes the earliest date from which you were required to remit tax in that state. That's why it's so important to track both your physical footprint and your sales activity across states, because either one can independently create obligations. Getting Nexus right is one of the most critical steps in sales tax compliance. If you underestimate where you have it, you risk undercollecting, and the state can hold you responsible for the collected taxes, plus penalties and interest. If you overestimate and register unnecessarily, you could create extra filing work in states where it isn't required. Knowing exactly where and when your obligations start allows you to stay compliant without overcomplicating your setup. And once you've identified your Nexus footprint, the next step is making sure you're registered properly in those states and collecting sales tax the right way. So with all of that said, you may be wondering how to actually collect those taxes. Well, for more information on that topic, check out this video. And remember, when in doubt, talk with a sales tax professional.